Let's now take a look at illustration number 2. X Company Limited, which is the issuer, issues debentures to Y Company Limited, which is the holder. These debentures are redeemable at the end of 10 years from the date of issue. Interest of 15% per annum is payable at the discretion of issuer. All right, so is going to be paid at the discretion of the issuer. If the issuer wants to pay interest, it has to pay 15%. Otherwise, it is not obligated to pay interest to the holders. The rate of interest is commensurate with the credit risk profile of the issuer. The question is, examine the nature of financial instrument. Now, if you actually think of this instrument is exactly similar to a non-cumulative redeemable preference share. It's similar to a non-cumulative redeemable preference share. Reason being, in case of a non-cumulative preference share, you have got no obligation to pay dividend. All right, the payment of dividend is at the discretion of the company, and even if you skip the payment of dividend in 1 year, you do not have the obligation to pay the dividend for the current year in the next year. All right, so this is basically an example of a non-cumulative plus redeemable, because in case of redeemable preference shares also, you have to actually redeem the instrument after a stated period. All right, so this debenture is actually the same as a non-cumulative redeemable preference share. All right, so whatever accounting we actually learn in this illustration 2 is going to be exactly the same for non-cumulative redeemable preference share also. All right, let's now take a look at how to account for this instrument. Now, if I start plotting down the facts, there is a company, which is X Company Limited, that has actually issued these debentures. All right, X Company Limited has actually issued these debentures. Let us assume that these debentures are actually issued on 1st of April 2021. All right, I'm assuming that these debentures are issued on 1st April 2021. The question has mentioned that coupon on these debentures is 15 percentage per annum. The coupon is 15 percentage per annum. However, this coupon is not mandatorily required to be paid. It is going to be paid at the discretion of X company. If X company wants to pay this coupon, it will actually pay the coupon. Otherwise, it can choose avoiding to pay. It can actually choose not to pay this coupon. That is what the question actually mentioned. All right, the interest of 15% is payable at the discretion of the issuer. If issuer wants to pay, it will pay. Otherwise, it can avoid paying the coupon of 15 percentage. Now, with respect to the principal, the question actually mentioned that principal is going to get redeemed. This instrument will actually get redeemed after a period of 10 years. So this instrument is going to actually get redeemed on 31st of March 2031. This is going to get redeemed on 31st of March 2031. I've issued it on 1st April 21. It's going to therefore get redeemed on 31st of March 2031. Now, if you look at this from X company's point of view, X company limited actually has got no obligation to pay coupon. The payment of coupon is actually at the discretion of X company, which means if it wants to pay coupon, it will pay. Otherwise, it need not pay. And therefore, there is no obligation on X company to pay coupon of 15% every year. All right. So with respect to coupon, there is no obligation to pay cash, and hence it actually fails the definition of financial liability. All right, for anything to actually get classified as a financial liability, the entity issuing that instrument should have an obligation to pay cash, whereas in this case, entity X company is actually not having an obligation to pay coupon. If you look at it with respect to principal, the X Company Limited has an obligation to actually redeem this instrument after a period of 10 years, which means that X Company has to actually pay cash at the end of 10th year to the instrument holders. All right, Y Company, which was the instrument holder, will actually receive cash after 10 years. So X Company is having an obligation to pay cash to Y Company after a period of 10 years, and therefore, with respect to principal, X Company actually has an obligation to pay cash. It has an obligation to pay cash to Y Company Limited after a period of 10 years. So therefore, if you notice, This instrument debentures is actually having the characteristic of financial liability and that of equity. It's having the characteristic of both financial liability and equity. Reason being, with respect to coupon, there is no obligation, which is basically equity in nature, where you do not have any obligation to pay cash, that is equity like nature. Whereas with respect to principal, X Company Limited has an obligation to pay cash, which is a characteristic of financial liability. All right. So this debenture instrument has a combination of both equity and financial liability, and therefore we are going to classify this instrument as compound financial instruments. We are going to actually classify it as compound financial instrument. If you look at the name itself, the term compound basically refers to a combination. The word compound basically refers to a combination. This is a combination of liability and equity. This is a combination of financial liability and equity, and therefore we are going to classify this debenture as a compound financial instrument. The debenture is going to be classified as a compound financial instrument. Now, what is the implication of classifying this instrument as a compound financial instrument? The implication is when we actually record the journal entry, we will record a portion of the proceeds received as financial liability and a portion as equity. All right, let us say if 10 lakhs is the total proceeds, let's say I received 10 lakhs by issuing the debentures, what I would do is a portion of this 10 lakhs will actually be classified as a financial liability, and the remaining portion will actually be classified as equity. All right, we are going to classify a portion of 10 lakh rupees as financial liability and a portion as equity. All right, so this debenture will actually appear under both financial liability section and equity section. All right, it's going to appear under both financial liabilities and equity section. Now the question would be, how do I measure the value of financial liability and equity? Yes, we have understood that the total proceeds of 10 lakh rupees will be bifurcated into liability and equity. The question is, how do I calculate the value of liability and the value of equity? Let's actually first see how financial liability value will actually be calculated. Now remember, financial liability basically represents an obligation to pay cash. Remember, a financial liability basically represents an obligation to pay cash. So the amount of financial liability will be measured as the present value of the cash flows that the entity is obligated to pay. The present value of the cash flows that the entity is obligated to pay. Now, if you think of it, what is the cash flow that the entity is obligated to pay? The entity is obligated to pay only the principal amount. Remember, the entity is actually obligated to pay only the principal amount in this case. All right, in this case, the entity is actually obligated to pay only the principal of rupees 10 lakhs after a period of 10 years. I'm assuming that the amount is 10 lakhs. The question did not give me the amount, but I am only obligated to pay principal of 10 lakhs after a period of 10 years. Now I will have to take the present value of this 10 lakhs. I have to take the present value of this 10 lakhs, and that value will be regarded as the financial liability component. All right. The cash flow that an entity is obligated to pay is only the 10 lakh rupees because the entity does not have an obligation to pay the coupon of 15% every year. Therefore, I am going to only take the present value of the cash flow that the entity is required to pay, and that will be the value of the financial liability. Now the question would be, what should be the discount rate that I am supposed to actually use to take the present value? The discount rate is actually supposed to be the market rate of interest. All right, the discount rate is actually supposed to be the market rate of interest, which means what is the interest rate that X company would actually pay in the market? What is the interest rate that X company will actually pay in the market? Now, in this question, the question actually clarified that the rate of interest that we are actually paying on this debenture, the rate of interest of 15% that we are paying on this debenture is commensurate with the credit risk profile of the issuer, which means what the question is clarifying is if X company would have actually gone out and borrowed money from some other entity also in the market, it would have had to pay 15% as the interest rate. All right. So the rate of interest on these debentures is commensurate or is in line with market rate of interest, and therefore the discount rate rate is actually going to be equal to 15% only. All right. Remember, the discount rate need not always be equal to the coupon rate. Hypothetically, in a hypothetical situation, let us say the coupon rate is 12%, but the market rate of interest is 15, then I am supposed to still use 15% as the discount rate. All right. I'm not necessarily always going to use the coupon rate for discounting. I'm supposed to use the market rate of interest. Therefore, if I calculate the present value will get calculated as year will be the 10th year from today. Cash flow is going to be equal to 10 lakh rupees, and I am going to take the present value factor at 15%. I'm going to calculate the present value factor at 15%, which is going to be equal to 0.2472. All right, it's going to be 0.2472, and therefore the discounted cash flow is going to be 2,47,200. The discounted cash flow will be 2,47,200. Why is the discounted cash flow such a small value? Because this 10 lakhs is going to be paid after a period of 10 years, and the discount rate being 15%, the present value factor is only 0.2472, and hence the discounted cash flow is coming as 2,47,200. Therefore, the financial liability value in the books of accounts will be equal to 2,47,200. It's going to be equal to 2,47,200 in the books of accounts. How did I calculate the financial liability? I actually told you that financial liability is defined as an obligation to pay cash. Now, such an obligation to pay cash is with respect to principal only in this instrument. Therefore, I take the present value of that obligation. That obligation value is 10 lakhs. The present value of 10 lakhs that's payable after 10 years is equal to 2,47,200. Therefore, out of the total proceeds that I received on day one, the total proceeds that I received on day one was equal to 10 lakh rupees. Out of that, 2,47,200 is being classified as financial liability. 2,47,200 is being classified as financial liability. Therefore, equity component is going to be a balancing figure. By default, equity component is going to be calculated as a balancing figure, which is going to be equal to 7 lakh 52,800. All right, so equity will be considered as a balancing figure. Out of the total proceeds of 10 lakhs, 2,47,200 is the financial liability, and therefore equity will be 7 lakh 52,800. The journal entry is going to be I will debit bank by 10 lakh rupees. I'm going to debit bank by 10 lakh rupees, and I will credit financial liability component of debenture. Financial liability component of debenture is going to be equal to 2,47,200, 247,200, and equity component of debenture is going to be recognized as 7 lakh 52,800. 7 lakh 52,800. All right, this is the journal entry that I am going to pass on 1st of April 2021. I'm going to record this journal entry on 1st April 2021. Just a quick recap. The coupon on this instrument was not mandatorily required to pay, so X Company Limited did not have an obligation. The principal is going to be redeemed after a period of 10 years, which means that X Company Limited has an obligation to pay, and therefore this debenture is classified as a compound financial instrument. Compound financial instrument basically represents a combination of financial liability and equity. All right, because coupon is not mandatorily required to be paid, that has a characteristic of equity, but the principal is mandatorily required to be paid, and therefore it has a characteristic of financial liability. Therefore, the debenture as a whole is going to be considered as a compound financial instrument. And in a compound financial instrument, we are going to bifurcate the total proceeds received between the financial liability and equity component. How do we calculate the financial liability component? Financial liability is going to be calculated as the present value of the cash flow that the entity is obligated to pay. Is the entity obligated to pay coupon? The answer is no. All right. Therefore, we are only going to consider the principal that the entity is actually obligated to pay, and we are going to discount it using the market rate of interest. And therefore, accordingly, we calculated the financial liability component, and equity component is basically the balancing figure. Now, this financial liability component of this debenture is going to be subsequently measured using the amortized cost approach. Now, if you do not know what amortized cost approach is, that's fine. You're going to learn it in separate detail later on. However, for now, what I would like you to understand is think of this 2,47,200 like borrowing. It's actually a financial liability. Think of it like a borrowing. So, what we're actually going to do is we will be recognizing interest on this borrowing at 15 percentage per annum. All right. What we would actually be doing is we will be recognizing interest on this liability. Just like how on any borrowing you have interest that is recognized, on this liability also, we are going to record interest at the rate of 15 percentage every year. Every year, we're actually going to record interest at the rate of 15 percentage. So if we actually calculate interest for year one, if we actually calculate interest for year one, the interest for year one would be 2,47,200 multiplied by 15 percentage. 2,47,200 multiplied by 15 percentage, which is going to be equal to 37,080 rupees. The journal entry for this is actually going to be I will debit interest expense. I'm going to actually debit interest expense in the P&L account by 37,080 and I will increase my financial liability. I'm going to increase my financial liability by the same value. I'm going to increase my financial liability by the same value. So after the interest for year one, the value of financial liability, the financial liability component at the end of year one is going to be equal to I originally had a balance of 2,47,200. I had a balance of 2,47,200. I'm now going to add interest of 37,080. I'm going to add interest of 37,080. Therefore, my financial liability value at the end of first year is going to be equal to 2,84,280. My financial liability component at the end of year one is going to be 2,84,280. Now, interest for the second year is actually going to be calculated on this 2,84,280. All right, I'm going to actually calculate interest for second year based on the closing balance of year one. All right, whatever was my closing balance at year one, I'm going to calculate interest on that closing balance. So therefore, interest for year two will be 2,84,280 multiplied by 15 percentage, which is going to be equal to 42,642. All right, so the interest for second year is higher than interest for year one. Interest for year one was only 37,080, but for the second year it's higher because I'm now calculating interest on interest. My financial liability value has increased and I'm now calculating interest on that increased liability. Therefore, my financial liability value at end of year two is going to be I had a balance of 2,84,280 at the beginning of year two. At the end of year one or beginning of year two, I had a value of 2,84,280. I add 42,642 to it, and therefore my closing balance of financial liability at the end of year two is going to be 3,26,922. All right, so what is actually happening is my financial liability is increasing year on year as a result of interest that I'm actually recognizing. This is what we actually do under the amortized cost approach. All right. So what we are actually going to do under amortized cost approach is we calculate interest at the market rate of interest. Think of this financial liability as a borrowing, or just like how on borrowings we calculate interest, on this financial liability also we calculate interest, and interest expense will keep increasing year on year because my financial liability value will actually keep increasing. All right, so if I actually plot it down in the form of a table, if I actually plot this down in the form of a table, I'm having years. I'm plotting down the opening balance of liability, the opening balance of financial liability. I'm then plotting down the interest expense that I have at the rate of 15 percentage. And then I am plotting down the closing balance of financial liability. All right, so in year one, I had a beginning balance of 2,47,200 on which I calculated interest at 15 percentage, which we actually had as 37,080. We had 37,080 as the amount of interest. Therefore, the closing balance of financial liability we saw is 2,84,000 282 lakh 84,280. The closing balance of year one becomes the beginning balance of year two. So my beginning balance for year two is going to be 2,84,280. Whatever is the closing balance will become the beginning balance for year two. Closing balance of year one will become the beginning balance of year two, and my interest for year two is going to be equal to, we calculated the interest as 42,642. 42,642. The closing balance is therefore going to be equal to 3,26,922. 3,26,922. That is going to become the beginning balance for year three. All right, the closing balance for year two will become the beginning balance for year three. On 3,26,922, I have an interest of 15 percentage, which is going to be 49,038. Therefore, my closing balance is now therefore going to be, it's 3,75,960. I'm going to have a closing balance of 3,75,960. The interest is going to get added to my opening balance to arrive at closing balance. This becomes my beginning balance of year four. So I have 3,75,960 as the beginning balance for year four. On it, I have an interest rate of 15 percentage, which is going to be equal to 56,394. All right, I'm rounding all the numbers. I'm actually not taking numbers in decimals. I'm rounding all the numbers. So I have interest of 56,394, and my closing balance therefore is going to be equal to 4,32,354. This is my closing balance for year 4. For year 5, this becomes my beginning balance 4,32,354. On 432,354, I have an interest of 15 percentage, which is equal to 64,853, and therefore my closing balance is going to be 4,97,207. For year 6, this becomes my beginning balance of 497,207. On that, I have an interest calculated at 15 percentage, which is going to be equal to 74,581, and therefore my closing balance is going to be equal to 5,71,788. For year 7, the beginning balance will become 5,71,788. On this, I am going to have interest at the rate of 15 percentage, which is going to be equal to 85,768, and therefore my closing balance will be equal to 6,57,556. This becomes my beginning balance for the next year. 657,556 becomes my beginning balance for 8th year, and on this I am going to have interest at the rate of 15 percentage, which will be equal to 98,633, and therefore my closing balance will be equal to 7,56,189. For year 9, the beginning balance is going to be 756,189. On this 756,189, I am going to have interest at the rate of 15 percentage, which is going to be equal to 1,13,428, and therefore my closing balance is now going to be equal to 8,69,617. For year 10, 8,69,617 becomes my beginning balance. On this, I am going to have interest at the rate of 15 percentage, which is going to be equal to 1,30,443. The closing balance therefore is going to be equal to 869,617 plus 130,443, which is going to be equal to 10 lakhs 60 rupees. It's going to be 10 lakh 60 rupees. If you actually think of it, I have a liability to pay 10 lakh rupees at the end of 10th year. Therefore, ideally, the liability value should have actually been equal to 10 lakhs at the end of 10th year. It should have exactly been equal to 10 lakhs at the end of 10th year. I've gotten 10 lakh rupees and 10 lakh and 60 rupees on account of a rounding difference. Ideally, it is supposed to be equal to the amount of cash that I need to pay at the end of 10th year. I am required to pay 10 lakhs at the end of 10th year. Therefore, the liability should have exactly been equal to 10 lakh rupees. All right, to exactly make it 10 lakh rupees, what I'm doing is I would like to reduce interest by 60 for the last year. I want to reduce the interest by 60 rupees for the last year. So the last year's interest would be 1,30,383. It's going to be 1,30,383 as interest for last year in such a way that the liability exactly be is equal to 10 lakh rupees. Now, so every year I am actually going to recognize interest on the liability. All right, I'm going to recognize interest on the liability every year, and the journal entry for that is going to be interest expense debit to financial liability component. So every year, my financial liability component value is actually going up in such a way that it exactly reaches 10 lakhs at the end of 10th year, which is equal to the amount of payment that I have to make to the holders of debentures at the end of 10th year. All right, so at the end of 10th year, I'm required to make a payment of 10 lakhs and my liability value will exactly have this amount. When I make the payment, the journal entry is obviously going to be I debit financial liability component. I am going to debit financial liability component by 10 lakh rupees and I will credit cash by 10 lakh rupees. I'm going to credit cash by 10 lakh rupees. Therefore, the financial liability component would then go down to zero. I had a credit balance of 10 lakhs and now I'm debiting 10 lakh rupees and therefore it's actually going to go down to zero after the payment of cash. That is with respect to subsequent recognition of the financial liability component. With respect to equity component, this 7,52,800 will exactly stay as it is. There is going to be no change to the value. We will exactly continue to report this as 7,52,800 under the shareholders funds. Remember, this financial liability is going to be disclosed under liabilities, whereas this is actually going to be disclosed under equity or under shareholders funds. Equity or shareholders funds mean the same, and it is going to be disclosed under the shareholders funds. The 7,52,800 will actually continue to remain the same amount. Now, if you remember, the question actually mentioned that coupon is payable at the discretion of the company. Coupon is actually payable at the discretion of X company, which means that if X company wants to pay coupon in the year 2022, it will pay. Otherwise, it need not pay. Now the question is, if let us say X company decides to make the coupon payment, how is that actually going to be accounted? All right, if let us say X company decides to make the coupon payment, will the coupon payment actually be debited to interest expense? Will the coupon payment be debited to interest expense also at the time of payment is the question. The answer is no. Over here, coupon is actually payable at its discretion. Therefore, that is equity in nature. Just like how when you declare dividend, you do not debit the P&L account, right? You debit reserves and surplus or retained earnings. Same way over here, coupon is also payable at the discretion of X company. Hence, when you actually pay coupon, that will not be regarded as a charge to the P&L account. It won't be an expense in the P&L account, but instead, we are actually going to debit equity component of debentures. If by chance X company limited decides to make a coupon payment, then we are actually going to debit this equity component of debentures. All right, if let's say X company pays and pays an amount of 15 percentage, that's going to be 1,50,000. We will actually debit equity component by 1,50,000 and we will credit cash. All right, so equity component will get debited by 1,50 and we will credit cash by 1,50,000. The 7,52,800 will then reduce by 1,50,000. All right, remember, just like how dividends are not recognized as an expense in the P&L account, over here also coupon which is payable at the discretion. Coupon is more like dividend over here. It's payable at the discretion of the company. So we do not debit P&L account. We will actually debit shareholders funds. Just like when we pay dividend, we debit our reserves and surplus or retained earnings. Over here also, we are going to debit shareholders funds component, which is the equity component of debentures for the payment of coupon that we actually make. All right, so that is how we are actually going to account for this instrument. All right, so this is a compound financial instrument, and we have actually seen how this is accounted on day one. On day one, we basically split the proceeds. We split the proceeds into financial liability and equity component, and subsequently, the financial liability is measured using the amortized cost approach, and any coupon payments that we actually make are going to be debited to shareholders' funds and not going to be shown as an expense in the P&L account. The expense in the P&L account is actually going to be represented by the interest that we have calculated. Whatever interest we have calculated at 15 percentage on this financial liability, only that is going to be reflected in the P&L account. Any payment of coupon of 15 percentage that we actually make will not appear in the P&L account. Instead, if we make such a payment, that will be debited to shareholders funds. Just like how dividend is debited to shareholders funds, even the coupon payment of 15% will be debited to shareholders funds. If you found this calculation a little complicated, don't worry. This is actually the amortized cost calculation, which you're actually going to see in multiple other numerical problems in the other in the other unit of this chapter. Therefore, do not worry. What you need to understand is the financial liability is like a borrowing, and on that borrowing, we are actually recording an interest at the rate of 15 percentage. All right, and we are basically doing a notional interest calculation. All right, the coupon that we are actually paying is going to be equal to 1,50,000. However, over here, the interest that we recognize in the P&L is not 1,50,000. This is a notional calculation that we have actually done over here. Now with that, we are done with illustration number 2. All right, we're done with illustration number 2, and illustration number 25 is also exactly the same as illustration number 2. All right, illustration number 2 is exactly the same. Illustration 25 is exactly the same as illustration number 2. Over here, the answer actually said that also refer illustration 27. That is actually a printing mistake. It's actually illustration number 25. All right, you can also refer illustration number 25 in the subsequent section, which is the same as illustration number 2.